Hi guys, Doc Severson here for the Theo Night Report for Tuesday, February 28th. I'll start out tonight's report on the S&P 500, and believe it or not, we're actually starting to see some market structure kick in like it's supposed to. Remember, what I do here is I look at three different time frames: monthly, weekly, and the daily, and this crazy blue indicator down at the bottom is what's called the choppiness index, what we also call fractal energy, because it basically shows the level of linearity of the current trend. So to explain how this works, what we're looking for is when we have very high levels of this, that means that we have a very non-linear trend. And really the way that you can think of this is just the spring getting wound up tighter and tighter and tighter until finally all that potential energy creates the next breakout. So breakouts and trends cannot go forever, even though it seems like it. So when the linearity of a particular trend gets down to a very dangerous level down here, where I see very, very few trends continue from that point, this is where we start to get into sideways price action. Now, it can be sideways, or it can also be the old pullback, or from whence it came. Either can do exactly the same effect, which is to bring up the non-linearity of the trend. So either a sideways move or a pullback or somewhere in between is what accomplishes winding up that spring for the next move. So we're already starting to see the daily chart now in about 5 days of consolidation. It's got a long ways to go before it's going to be ready for the next trend. Not to say that just because I have some line on here that the price can't do whatever it wants to do. But as we go up to the next larger trend or time frame in this case, which is the weekly chart, we also have a level of what I call exhaustion on here on the weekly chart, which is very consistent with where we've seen reactions in the past. A reaction is something like this that we saw about this time a year ago. Another reaction is something like this that we saw last summer after the Brexit vote. So I'm expecting to see the price range somewhat larger than it is right now. So for this particular trend to sort of fall into this time frame's linearity, so for the weekly chart to fall into the same type of non-linear price action, means that it's going to fall into a slightly larger range. But trust me, when we see that first red candle that announces that the range is being built, people are going to lose their minds. Quite honestly, we went through the same thing after 2013, 2014. This is where a lot of people became instant geniuses trading the bull market. And the first red candle that they saw that came along caused great deal of anguish, right? And so, of course, that was followed by several more, which really wiped out a lot of the new hands that were involved in this, and then the market goes off and does what it does the best, right? So once he's left them on the shore, the market's free to go where it wants to go. So that's the S&P. Now, today, what we saw was a little bit of a reversal on the Russell. So the Russell yesterday got a big bid, big rally up, and today ate all of that back. So that's a, whether you call that a dark cloud cover or just a bearish engulfing pattern. This is a fairly bearish candlestick, but in light of the larger context here, what I would expect to see is just more of this nonlinear price action. Similar to what we saw really throughout December and January with the Russell, where go up for a couple of days and then down for a couple of days, and up for a couple of days and down for a couple of days. So all of this is what I would call, again, non-linear price action, and this tends to build up the energy again. So the Russell looks like it's ready to go, at least on the weekly chart, but I wonder what's going to happen here. If we see a reversal coming from the top, this is especially going to be dangerous here, because the Russell can be a canary in the coal mine for fund managers. So what this means is that the Russell stocks tend to be very illiquid. So if a fund manager is holding a lot of Russell stocks, they have to sort of tiptoe out of these. So they have to get the early move on these. Otherwise, if the market starts moving down in earnest, then fund managers dumping and taking risk management steps to protect their portfolio end up moving the market against themselves on their own stocks. So that's one thing to keep in mind, is that sort of canary aspect. The other thing to keep in mind with the Russell stocks is that they are going to be more sensitive to interest rates. So the larger multinationals are going to be more sensitive to things like the currency exchange, where if the dollar gets too strong, then all of a sudden their products become less attractive overseas, whereas most of the Russell stocks are going to be more U.S. domestic, but they're all funded based on debt. So if all of a sudden the interest rate starts to go up, then these stocks are going to have their bottom line hit by the interest payments. So I would think the thing that we want to watch here is going to be either the 10-year note is going to be more of a predictive indicator for us than watching actually the wait until mid-March for the Fed. So right now we're kind of in a stalling pattern on this, or we can watch the dollar index through DX here. We can see whether or not this is starting to break higher. This will probably also indicate that perhaps rates are going to be rising. Now, the market seems to care a whole lot less about what the Fed has to say these days because, frankly, organic growth is going to be much, much more powerful and stronger, as we've already seen, than just about anything that the Fed can do at this point, not necessarily saying what it could do in the past. Certainly, we saw massive rally in 2013, 2014 based on Fed liquidity. Okay, but those days are over now. They're trying to reel that back in, and so organic growth is really the thing. So watching the Fed numbers here, this is the latest Fed watch, and right now we're saying about a 40% probability of a hike coming up in a couple of weeks. So we'll watch that one carefully. And these numbers have a way of fluctuating quite a bit. There's quite a bit of volatility in these numbers that we've seen. So this one was much lower just a couple of weeks ago and has started to creep up. Now, one more thing I want to mention on the charts. This is the volatility futures here. And so this is the current March 17 volatility futures. And one thing I do want to mention is that we've seen a little bit of a move up here recently. A lot of this has to do with the speech that's being given tonight by the president. So it's his version of the State of the Union address. And I think a lot of people are nervous about this. I think those concerns are being overblown somewhat when everybody knows about the fact that something's coming up. Usually this is where we see the opposite effect of that actually kicking in. But I do want to mention here that with this slight bump up in volatility that we've started to see, this is pretty common with some of the other big moves that we've seen, is that we start to see this move come up well in advance of the actual peaks that come along here. These moves start to come well in advance of the actual peaks for this. You can see this again and again and again through the past couple of years here. So let's watch this carefully. We are a little bit overdue for a lot of volatility to come into the market and kind of normalize things and kind of hit that reset button again. All right, folks, that is it for tonight's report. Thanks for listening. See you tomorrow.